Efforts to reduce reliance on the US dollar in global trade and finance, known as dollarization, have historically been driven by the BRICS nations. These countries share a common objective of asserting financial independence and minimizing their exposure to vulnerabilities tied to a US-centered global financial system. Over the past decade, they have actively pursued alternatives to the dollar. While the BRICS countries have long been leaders in this movement, the trend is now gaining momentum in Europe, with France playing a pivotal role. In this video, we explore the growing trend of dollarization, a movement that is now gaining traction even among traditional US allies. This shift comes at a time of political upheaval, particularly following the recent collapse of the French government, which could introduce new challenges to trade relations between France, China, and the United States. Before delving into France's recent initiatives and the European Union's support for promoting alternative currencies and diversified trade mechanisms, we first examine the historical evolution of trade relations between the EU and China. Understanding this foundation is crucial to grasp the current dynamics and the strategic choices shaping the future of these economic partnerships. Historical milestones in EU-China. Trade relations. The EU-China trade relationship began in 1975 when the European Economic Community, EEC, established diplomatic ties with China, marking the start of structured economic engagement between the two regions. This laid the groundwork for deeper collaboration over the following decades. In 1985, the signing of the Trade and Economic Cooperation Agreement further expanded trade and investment ties, formalizing the economic partnership and setting the stage for mutual growth in bilateral trade. A major turning point came in 2001 when China joined the World Trade Organization, WTO. This was transformative for EU-China trade, as it reduced trade barriers, improved market access, and catalyzed a rapid increase in trade flows. China's WTO accession also required it to adopt international trade norms, boosting confidence among European businesses and fostering greater economic interdependence. In 2003, the establishment of a comprehensive strategic partnership further strengthened bilateral cooperation, covering not only trade but also political, cultural, and technological exchanges. This partnership emphasized a shared commitment to addressing global challenges and deepening economic ties. Over the years, the relationship has evolved to encompass dialogues on climate change, innovation, and sustainable development, reflecting its growing complexity and importance. Trade volume and structural imbalance. China has become an indispensable trading partner for the European Union, with bilateral trade in goods reaching approximately $739.5 billion in 2023, which translates to an average of $2.03 billion in daily trade. This robust exchange highlights the deep economic interdependence between the two economies, driven by extensive trade in machinery, vehicles, pharmaceuticals, and consumer goods. However, the relationship is marked by a significant trade imbalance, with the EU's trade deficit with China standing at $291 billion in 2023. This imbalance reflects the EU's reliance on Chinese imports in key sectors such as electronics and industrial machinery, while facing barriers to market access in China. A closer look at the trade dynamics reveals the prominent role of machinery and transport equipment in bilateral trade. In 2023, the EU exported approximately $114 billion worth of machinery and transport equipment to China, while importing nearly $296 billion in the same category. Electronics, particularly telecommunications equipment, also stood out as a key import segment, with the EU importing $56.3 billion worth of such products from China. Industrial machinery also makes up a substantial portion of the EU's imports, underscoring the bloc's dependency on China for critical manufacturing components. The European Union (EU) exports a variety of chemical products, including pharmaceuticals, which have become key players in its trade portfolio. This highlights the diversification of EU exports, moving beyond traditional goods. However, despite the substantial trade volumes, the EU faces numerous challenges in its economic relationship with China. EU businesses often encounter significant regulatory barriers and restrictions on foreign investment in China, which hinder their ability to compete effectively in the Chinese market. These obstacles make it difficult for the EU to balance trade flows, as opportunities for European exporters remain limited compared to the influx of Chinese goods into Europe. The growing trade imbalance has led the EU to take protective measures to safeguard its industries and ensure fair competition. For instance, in 2024, the EU imposed anti-dumping duties on Chinese titanium dioxide imports, with duties ranging from 0.25 to 0.74 euros per kilogram. This move aims to protect EU producers from unfair pricing practices. Similar measures have been applied across other sectors to address concerns over underpriced Chinese goods flooding the EU market. While the economic interdependence between the EU and China has brought significant benefits, it has also raised important questions about sustainability and fairness. The EU's reliance on Chinese imports for critical goods, coupled with its struggle to penetrate the Chinese market, underscores the need for strategic policy adjustments. Dialogue and negotiation will be crucial in overcoming these challenges, as both parties work to preserve a partnership that is not only economically robust but also equitable and mutually beneficial. Ongoing issues, such as the stalled ratification of the Comprehensive Agreement on Investment (CAI), and the imposition of trade defense measures, reflect the complexities of navigating this multifaceted relationship. As both economies continue to engage, finding common ground on trade policies and addressing systemic issues will be pivotal in ensuring the long-term stability and prosperity of their partnership. Escalating trade tensions. In recent years, the trade relationship between the EU and China has been marked by increasing tensions. In 2023, the EU launched an anti-subsidy investigation into Chinese electric vehicle (EV) imports, alleging that substantial state subsidies gave Chinese manufacturers an unfair competitive edge. This investigation is part of the EU's broader efforts to protect its industries from market distortions caused by China's state-driven economic policies. The inquiry seeks to ensure a level playing field for European automakers who are facing growing competition from affordable Chinese EVs flooding the EU market. In response, China initiated anti-dumping investigations in 2024 targeting key European exports, including pork and dairy products. These measures were perceived as retaliatory, further escalating the trade tensions between the two economic powers. The targeting of agricultural exports is particularly concerning for European producers, as these sectors have traditionally been strong in the global market. The situation intensified in late 2024, when China filed a case against the EU at the World Trade Organization, WTO, challenging the EU's anti-subsidy actions and accusing it of violating international trade rules. This filing signals the increasingly adversarial tone of the bilateral trade relationship, with both sides locked in a cycle of tariffs, investigations, and disputes. The EU and the dollarization trend. In a surprising development, Western nations, including EU member states, have begun exploring ways to reduce their reliance on the US dollar in international transactions. France and Germany have made notable strides in this direction. In March 2023, France made headlines by conducting China's first liquefied natural gas (LNG) transaction settled in Chinese yuan. This landmark deal, involving the import of 65,000 tons of LNG from the United Arab Emirates, marked a significant step in expanding the use of the Chinese currency in global energy markets. This transaction was followed by additional agreements, including a partnership between France's energy company, Total Energies, and China's state-owned energy giant COK. These moves signify growing willingness among French firms to engage in yuan-denominated trade, particularly in key sectors like energy. This shift is part of a broader trend that aligns with China's strategy to promote the yuan as a viable alternative to the US dollar in global commerce. For France, conducting business in yuan offers a way to mitigate risks associated with currency fluctuations and the volatility of US monetary policies, while strengthening economic ties with one of the world's largest markets. EU concerns and initiatives. The European Union has increasingly expressed concerns about the weaponization of the US dollar, particularly through its use in sanctions that have wide-reaching effects on European businesses operating internationally. These sanctions have placed European firms in a precarious position, facing restrictions that often undermine their competitiveness in global markets. Consequently, the EU is exploring alternative approaches to reduce its dependence on the US dollar, particularly in strategic sectors like energy and trade with China. The growing trend of de-dollarization is seen as a way for Europe to protect its economic interests and regain some measure of autonomy in global financial matters. In conclusion, while the economic relationship between the EU and China holds significant promise, it is also fraught with challenges that require ongoing dialogue, strategic adjustments, and a concerted effort to create a more balanced and sustainable partnership. The EU's push for fair competition, the increasing use of the yuan in international trade, and the evolving tensions in trade policy all point to a future where the EU is keen to assert its interests on the global stage, even as it navigates the complexities of its relationship with China. The global financial system faces vulnerabilities, particularly due to the dominance of the US dollar. This often forces European entities to comply with US foreign policy decisions, which has led to growing unease within the European Union. In response, EU leaders have been exploring ways to reduce dependence on the dollar and strengthen the euro's role in global trade and finance. By 2023, the euro's share in global foreign exchange reserves had fallen to 20%, highlighting the challenges the currency faces in maintaining its status as a major reserve currency. In reaction, EU policymakers have made it a priority to enhance the euro's global standing. A key focus has been encouraging the use of the euro in strategic sectors, particularly in energy contracts. The EU has urged its member states to denominate more energy transactions in euros, especially in light of changing global energy dynamics and efforts to secure energy independence. The exploration of a digital euro has also become a prominent avenue to boost the currency's international standing. A digital euro would modernize the EU's financial infrastructure and offer a solid alternative for cross-border transactions, reducing reliance on third-party currencies and systems. This initiative is part of a broader strategy to ensure the euro remains competitive in an increasingly digital global economy. At the same time, financial integration within the EU is seen as crucial to achieving these goals. Enhanced coordination among member states on fiscal policies, banking regulations, and capital markets is essential to building confidence in the euro and expanding its appeal to international investors and traders. By addressing these internal challenges, the EU hopes to solidify the euro's position as a stable and reliable alternative to the dollar in a multipolar financial system. As the dollarization movement continues to gain momentum, its impact on global trade and finance will unfold, driven by both economic pragmatism and shifting geopolitical dynamics. Thank you for watching this video. We truly appreciate your time and support. If you found this content insightful, please like and subscribe to stay connected with our community. Your support means a lot to us. You can also check out another video from our channel now displayed on your screen.